Dear student, we will be discussing today the chapter 9 of the auditing papers because there are some amendments in the CARO report 2016. We will be discussing the whole CARO report today, and because it has been effective for the accounting year ending on 31st March 2016, and therefore it becomes somewhat important for the exam to be conducted in November 2016. This CARO report was also earlier. There was a CARO 2013, and there are some more points have been added in CARO 2016. What are the amendments? Amendments are somewhat the additions, but there are some of the amendments are in the applicability of the CARO report. Applicability, if you see here that this CARO report is not applicable to banking company. It was not applicable earlier also. It is not applicable to insurance company. It is not applicable to company license and operate under section 8. It means the companies which are for the charitable purpose, and therefore this order does not apply to them. The earlier CARO report 2013 was also the same. It was not applying to the companies which are formed under section 8. The earlier Companies Act 1956, the section was 25. One person company, you know that as per the Companies Act 2013, now you can incorporate a one person company. There will be only one person, only one member in that company. And because they are generally a small company, these one person companies, there are certain limitations in it. And therefore the CARO report does not, the auditors need not to give a report on CARO in that case. Basically, what is the concept behind the CARO is that because this CARO is basically about getting a certain information and confirmations from the auditors regarding about certain points, and that is basically for the larger companies, it's some mid-sized companies, and therefore it does not apply to the small companies. As far as the other companies concerns are like banking company, insurance companies, they are different and they have got their own regulatory authority for it. And in case of the banks, if you know that in the bank there is a report on the internal control system, like you have got a long LFAR, long form audit report there, and which is somewhat more extensive than the CARO reports, and therefore it does not apply to the bank. It is in the case of the insurance company because they are regulated by the IRDA, and IRDA does not mention about, and they don't require such type of confirmation from the auditors on the certain issues. Now, there are small companies which are defined under Companies Act section 2, subsection 85. And in small companies, as you know, there is some the conditions for those small company. At present, it is the turnover is 2 crores. The paid up capital should not be more than 1 crore, or somewhere I think it's 50 lakhs. But they can be changed, but it should not exceed 10 crores. But at present, I think it's 50 lakhs, and that's why it does not apply to the small companies as defined under Companies Act 2013. It does not apply to the private limited company. And basic concept what you have to see in that case is that if the private limited company is a small company, then maybe because it does not apply to small companies, but it does not apply more than if there are certain companies which are not small companies, but they are bigger than the small companies, but still this report does not apply to them, and there are certain category of the private limited companies. And what are those categories are that CARO report say that should not be a subsidiary or holding company of a public company, because these CARO reports apply to the public companies whether they are listed or unlisted. And if the private limited company is a holding company of this that public company, or private limited company is a subsidiary of the public company, then it applies to it, whether it is a small company or whether it is a may not be is paid. Then other thing does not apply. That it is not a small, then it's not a mid-sized company. It is not a SME in that case. So if it is a holding company of a public company or a subsidiary of the public company, then CARO applies, irrespective of the fact that what is its turnover, what is its paid up capital, reserves, nothing else. Aggregate of paid up capital and reserves and surplus is less than or equal to 1 crore as on the date of the balance sheet. Balance sheet date means if you are reporting on 31st March 2016, then this position will be taken as on date, because there are in some cases the position has to be taken for some which will come later on about the borrowings or something else, which has to be taken up during the year. But here it is as on date. On 31st March 2016, if the borrowings reserves and surplus and paid up capital does not exceed or is not equal to 1 crore, then this does not apply. It means if it is less than 1 crore, the paid up capitals and reserves and surplus, then the CARO order does not apply to it. Basically, the concept is the same one. Concept is that it's a small company. That's why they are saying it. But when we are talking about this conditionality, the conditionality, they should fulfill all the conditions. If any of the condition is violated, then it applies. Total borrowings from the banks and financial institutions at any point of time during the financial year does not exceed 1 crore, 1 crore or more. So that is the one condition. And here if you notice it, here it is during any time during the year, any time during the year. Means on 31st March 2016, when it is a date of reporting, maybe that on that the borrowings is suppose 80 lakhs. But during on 31st December 2015, the borrowing exceeded, it was 1 crore 5 lakhs on that date. Then the CARO report, the auditors has to give out CARO reports, because during the year, any time if it exceeds 1 crores, then the CARO report has to be given and has to be issued by the auditors. So it is during the year. Whereas in the first case, when we are talking about the reserves and surplus and paid up capital, it was on the date of reporting. And if date of reporting is 31st March 2016, then on 31st March 2016, maybe that earlier it was more than 1 crore, then the first condition will be satisfied. But as far as the borrowing is concerned, it says any time during the year. Do you understand? Basically, what is the concept behind it? It wants to cover up all the companies where there is a somewhat a public interest is there. If the public interest is there, they feel that if a company has taken a more than 1 crore of loan, because the public money is involved in that company, and therefore the Companies Act requires that the auditor should give and confirm and informations during the year in the form of the CARO. And you have around the 16 points in that CARO, and that should be reported by the auditors if any of the condition is not complied with. All the condition has to be complied, not one. So when we are talking about all these, I have explained your 3 conditions. The last one is about total revenue. Now question is that what is the revenue? And it has been well explained in this CARO order. There was no dispute, as in the another CARO, the previous CARO, there was somewhat debatable points that what is the revenue. But here it particularly say, including revenue from discontinued operation as disclosed in the financial statement as per Schedule 3. Schedule 3, as you know, that it's where the formats of profit or loss and the balance sheets are given, and the requirements of preparation of the financial statements are given. That is in the Schedule 3 of the Companies Act 2013. And they say that whatever the revenue from operations are given in that will be taken into account, and if it is equal to or it exceeds the 10 crores, then the CARO order applies, and the auditor has to report this CARO in their audit reports. So these are the conditions, and these conditions are basically the cumulative one. Each condition has to be satisfied. It is not that out of these 4, if 3 are satisfied, no, still the CARO report has to be given. So all the conditions must be satisfied, and for your remembering purpose, dear student, you can see that it is basically where some public interest is involved, then the CARO report has to be given. For that purpose, this CARO report has categorized the companies where they feel that from where the public interest arises. What are the criteria where we can say that in that company the public interest is there, and that's why they have put a criteria about the paid up capital, reserves, borrowings from the financial institutions, and like this. and the turnovers. Because if it is turnover is more than 10 crores, then means the public interest, maybe it may have a more creditors, more debtors, where a lot of public people are involved with that one, and then they feel that the such company requires a more reporting and more confirmations from the auditors that regarding certain interest, certain points which we'll be discussing later on. So these are the applicability. Dear student, in the exams, you may be asked sometimes, there may be a situation, as you know in the CA final exams, you will be given a situations. There are no straightforward questions here. They may say that this is the company, ABC and Limited is the company, it has got this much of paid up capital and reserves are 80 lakhs. It is not a subsidiary of any company, it is not a holding of the public company. On 31st December 2015, it was having because it has got a CC account with the banks, and it has got a limit of 1.5 crores with that. And on 31st December 2015, the CC limit was having a credit balance of rupees 1 crore 5 lakhs. Whereas on 31st March 2016, it was 80 lakhs. So then they will say whether the CARO applies or not. Then you have to put all these 4 conditions there, and in any of the conditions is violated, certainly in this case, as regards the borrowings, the condition is that if any time during the year, if it exceeds 1 crores, then the CARO applies. And therefore, you have to say that in this situation, because this condition is not met, it is not complied with, and therefore the CARO applies, and auditor is required to report for the CARO in their auditor's reports. These are these additional points, because the general report is there. In addition to that, the CARO has to be reported, and now from 2016 you must be knowing that in Annexure B you have to report the internal control over financial reporting also. So we are talking about here CARO, and the CARO has to be reported under these conditions if those conditions are not met. Now we'll be discussing what are those points on which the auditors are required to report. And he has to report it, whether this is yes or no. He cannot escape it. If it is not applicable, certainly they have to be written that this point is not applicable, and why it is not applicable, it must be written. So that is the way of reporting here. It doesn't mean that if there are 16 points out of it, and suppose out of that 16 points, that 10 points are not relevant for the particular company under which you are auditing that company, and you have to issue the CARO report for that company. If the 10 points are not applicable, please put the points and write against that one which is not applicable and why it is not applicable. So reporting has to be done on all these 16 points. Now the first point is about the fixed assets. Dear student, you must be whenever you do the auditing, and certainly the fixed assets fixed asset forms a sizable part in the balance sheet in the asset side, and certainly it requires you must be examining in your general audit procedures. And it is not that for the CARO you will be doing it. For the CARO, you are not doing the fixed assets audit only for the purpose of reporting under the CARO. Under your general audit programs and the procedures, you have to verify whatever the fixed assets amount, whatever is shown in the balance sheet, it exists on that date. It is carrying amount, and whatever value is presented in the written in the balance sheet, is it okay as per the accounting principles? Or you have to say that whether the presentation, because presentation is written in case of in Schedule 3, it says that how it has to be presented, where it has to be presented, and if that presentation is according to that one, certainly it has to be checked whether you do the CARO or not do the CARO. But the CARO requires the auditor's confirmation, auditor's reporting on these 4 specific points, 4 or 3 specific points. And what are those points? Whether the company is maintaining a proper records showing full particulars including quantity details and situation of fixed assets, auditor has to report on it. What report is proper records? Whether the company has maintained a proper records for it. And what are the proper? Because see, what is the proper? Certainly it's a judgment of the auditors in that particular situations, in the particular companies which you are going to audit. What is the proper there? The auditor will take a call on that, and the auditor will take a decisions on it. But they have given us some example of it. What cannot be property? There should be a full particulars, including quantitative details. Suppose you have a plant and machinery, you will write on which date you have purchased it, what is the name of that plant and machinery, where is the situation, where it is installed, in factory in Ahmedabad, factory in maybe Hyderabad, and you have got lot of factory, where is that plant is situated, and where is the locations of that plant, what is its cost, what is the accumulated depreciation on it, what is the depreciation of during the year, and what is the carrying amount in the balance sheet. So these are the particulars which is certainly needed in that one, and whether that exists or not, whether the physical verifications has been carried out of the management, that we are going to the second point. So these are the what is the proper. When we say what is the proper, these are the proper as regards the fixed assets. Now we say that including quantitative details and situation of fixed asset must be written, and that these are they have given you points, that these are the important points regarding the quantitative details. Whether it's a 1 plant, 2 plant, 3 plant, you have to write. You have to write where it is located, where it is placed. If it is a case of a furniture fixtures and you have a office in a you are occupying a 10th floor of that particular building, in which floor this furniture fixture is located, who is the person to whom you have issued it. You may write the officer's name, that these fixtures and this table, chairs is with that officers. You have to mark. You must be marking on that, because that will be the proper, that this is what is the serial number of that furniture fixture, this table, chair, there will be marking on it. So that will be considered a proper. So but ultimately it's the auditors who have to take his judgment that what is proper. Now the next point is about the fixed asset. What the auditors is required in under CARO is whether these fixed assets have been physically verified by the management at reasonable intervals, whether any material discrepancies were noticed on such verification, if so, whether the same have been properly dealt in the books of accounts. Dear student, you will be doing these points in your general audit, whether these are CARO or not CARO. But here, and if you found it okay, then you don't report it in the main report. But here in the CARO, what is the difference? You have to report whether it's yes or no. Whether if it is okay, then still you have to report. If it is not okay, then again you have to report. So these requires a specific reporting by the auditors. So that's why the Ministry of Company Affairs, who have promulgated this order, that it requires whether it's yes or no, both you have to tell in that report, whether the physical verification was carried during the year. They might have carried on one time in the physical verification. Suppose they carried only once in a year. Your accounting year ends on 31st March 2016. They carried a physical verification of the assets on 31st December 2015. Only one in the year. The auditor has to report whether it's reasonable to conduct a physical verification of those fixed assets only in 1 year, once in a year. Is it okay? It's a proper, it's a reasonable. That the call which the auditor has to take, because it is his judgment whether it is reasonable or not. If he feels it's not reasonable, because the fixed assets consist of the computers, all PCs, computers, laptops, and these ones, and they feel that no, because there are a lot of turnovers in network, they get obsolete during the year so much. So they may feel that no, once in a year it's not sufficient. It should be at least twice a year. So that's the reasonability which the call the auditor has to take, and it is his discretion. It is left to his discretion under the particular situation whether conducting a physical verification of the fixed asset once in a year is reasonable or not. So that's the auditor's call he has to take. Such verification, if so, whether the same have been properly dealt in the books of the accounts. Because you see, the physical verification, to conduct a physical verification is the responsibility of the management. It's not a responsibility of the auditors. Auditors' job is, auditors' responsibility is to report on that physical verifications. So, as an auditor, you must have to verify first whether, and you have to convince yourself, get an assurance whether the verification was done or not. Suppose you went in a company and you say that yes, there are a lot of fixed assets, there are plant and machinery, furniture, fixture, computers, all these office equipments are there. And you ask whether you have conducted a physical verification during the year. They say yes, yes, we have conducted. They give you a certificate. Yes, we conducted a physical verification and everything was found okay. There was no discrepancy like this. The question arises whether you can rely on such type of certificate of the management. I think not. Because what you are required to report is that whether the company has conducted a physical verification. It does not say that they give you a certificate, then they have conducted. No, you have to ensure that whether the certificate given is okay or not. You have to apply due diligence. There's a representation you are getting from the management, and you know there is a SA 580 which talks about that what you have to apply due diligence procedures to the management representation which you got from the management, and after that you can use it as audit evidences. Otherwise, management representation has no value at all. You can't use it as audit evidence. You cannot say yes, I took this representation from the management and they wrote that yes, we conducted and there is no discrepancy. No, you will ask them when you conducted, who conducted, have you given you have so much of, you have a 5-6 branches of this company, the 5-6 location where the fixed assets are there, whether you issued a certain instruction to the persons who conducted a physical verification, what are their name, you must have prepared certain records for it, physical verification sheet, who conducted it, whether you will show those records. If they are not able to show you, no sir, we haven't prepared any records, then certainly then you can't, how could you report them? You cannot report on their certificate that there is no discrepancy. So that is the thing which the auditors has to do for that. And if there is a discrepancy, if there are a minor discrepancy, they may feel that no, it has been dealt with. And if there are a major discrepancy, they have passed a corrective entry in the books of accounts, fine. Then it has been dealt with correctly. If it is not, then auditor has to report. Whether the title deeds of immovable properties are held in the name of the company, if not, provide the details there. This is the new point which has been added in CARO 2016. Do you understand? When you are auditing the fixed assets, certainly you are seeing whether this ownership lies with the company or not, because it is a presumption. If something is shown in the plant and machinery, or suppose there is a building, it is being shown in the asset side of the company balance sheet, it is presumed that this building is owned by the company. But sometimes it is possible, because you know that as per our accounting principles, which is laid down in case of the at present in AS 10, it says that it does not talk about the ownership, legal ownership, because you can have that particular building in your balance sheet, but you may not having a legal ownership out of it, because what it say that fixed assets which are used for more than 1 year, it's a question of use. It's not, the fixed assets are defined not by the legal ownership. And certainly we have a fundamental principles of accounting which we talk about, that it's a substance over the legal form, and the legal form is that legally you own it. Substance is that you may not be owning it because you purchased it. You may have purchased in 2014, and because the registration is yet to be done, because there are certain formalities in it, it is taking time. But you have given the money for purchasing that building, you are using that building, but still it is not in your name. Legally, in the registrar office, it is not in the name of the company. Then it requires a disclosure in the financial statement. And maybe that the auditors may invite attention to in his report if it is a very sizable and if he feels that it is so. Otherwise, but the CARO 2016 has put a responsibility on the auditor that please check the title deeds of the immovable property, and if it is not, then you write that this building is not in the name of the company, and because it is under registrations. So you have to check the title deeds of all the properties. If it is not with the company, maybe the title deeds are being mortgaged, they have to be mortgaged with a certain banks. So you have to ask it from the banks. You have to ask from the banks, and they may confirm that it is in their name, and like this you can take a certificate from the bank, or you can, for the timing, you can also visit to the bank to see those title deeds there. So that is the reporting which the auditor has to do about the fixed assets. Do you understand? The second point is about the inventories, and that inventory, what the auditor's requirement, what it has to report, what it has to confirm, whether physical verification and inventory has been conducted. The same one as we talk about the fixed assets, but that was the fixed assets. Now it is a inventories. It's a current assets. Again, it says whether this physical verification is reasonable intervals. There we talk about, I told you that maybe the 1 year in case of the fixed assets, if the management conducts a physical verification once in a year, that may be reasonable in case of the fixed assets. But that may not be reasonable period in case of the inventories. And therefore, again he is asking whether the physical verification and inventory has been conducted. You have to write, yes, it was conducted. But whether it's reasonable, they can take an example. Whether 1 year is reasonable or not. It's a retail industry. The company is in a retail business. It has got 100 departmental stores, and they are conducted. The lot of thousands or even maybe 20,000 items are lying in the departmental stores. Now, the company is conducting an inventories physical verification only once in a year. Do you understand? Can you tell me that whether that conducting a physical verification once in a year in case of the company which is in a retail business, is it reasonable? I think not. Considering the volume, considering the mobility of those items, number of items, perishable items, their life may be very short. These all things gives a reason to you that conducting a physical verification once in a year in case of inventories of the company which is in a retail business may not be reasonable. They may say that at least twice a year, thrice a year, or 4 times a year. It can be. So auditor has to report whether this is reasonable or not. Maybe that there may be certain companies which is selling the plant and machinery, very big item, maybe the car manufacturers, maybe that in that case the physical verification or inventories once in a year may be sufficient. So it is the auditor who has to take a judgment in a particular situations. If any material discrepancies were noticed, they found that there is excess inventory in the physical verification, shortage in the physical verification, that has to be dealt with in the books correctly, and whether the company has dealt it and passes entries entered in the books of accounts or not, that you have to also report. Do you understand? The next point is loans to directors and interested parties. The new Companies Act 2013, they have put a lot of restrictions on the payment to the directors, loans to the directors, and that you must have studied in section 189 in your Companies Act paper. So what it says that whether the company has granted a loans secured, unsecured to companies, firms, limited liability partnership or other parties covered in registered matter under section 189. 189 section means where the directors are interested. So you cannot give a loan to the directors, to the interested parties also, or the firm, company where the directors is interested. So that is defined. You must have studied this section in detail in your corporate law paper, and therefore what is the requirement here? The auditor is that whether the company has given the loans secured or unsecured to the company's firm, limited liability partnership or other parties covered under registered maintenance 189. You can see the registers maintained on 189. There will be parties which will be jotted down there, and you can see whether there are any transaction with those parties or not. And if there are transactions, there is a procedure under the Companies Act. They can enter into transaction with those parties provided certain procedure is followed, and that is written in the Companies Act. And if that is followed, fine. If it is not, then certainly the auditor has to report. And that's where this ABC point arises there. Whether the terms and conditions of the grant of such loans are not prejudicial to the interest of the company. They might have given a loan to the director or the relative of the director at the interest rate, which is very cheap. Maybe that if the market rate of interest is around 10% and you have given a loan at a 6% to the relative of the directors, maybe it will be considered as a prejudicial to the interest of the company. And then you have to report. You have given a loan, maybe that loan you have not taken a proper security for it. You have not taken a proper documentations for it, and in that case what will happen that suppose they make a default and you will not be able to, you have no security against it, you are not able to file a suit in the court of law because your documents are faulty. So there the auditor has to take a judgment whether it's a prejudicial to the interest of the company or not. Whether the schedule of repayment of principal and payment of interest has been stipulated, whether the repayments or receipts are regular. So this is the point which you have to see, whether if they have taken a loan, there are certain terms and conditions. If the terms and conditions that quarterly they have to make a payment of this much of principal, this much of interest, whether they are paying it regularly or not, if the word is regularly. They understand it's not that they may have paid, suppose the installment becomes due on 30th of September 2015, whether it is not necessary that they pay on 30th September 2015, they may pay on 7th October, 8th October, 9th October, maybe within 10 days, fine. Every time he is paying like this, so it will be, what it say that whether the repayment is regular. So you have to take a call whether it's a regular. Yes, it may be considered regular. If you pay after 2, 3, 4 days, fine. So it is not necessary that they should pay on the date of the due date. They may be allowed a certain period of 3, 4 days for that, and if he's paying within 3, 4 days, then it will be considered as a regular payment. If the amount is overdue, state the total amount overdue for more than 90 days. This is the point which has been particularly written here, 90 days. Earlier it was not there. Whether the payment is overdue by 90 days means when it becomes a due, then it is more than now the 90 days has exceeded and then payment has not been made. It is just like that in the banks. So you see that when the NPA is declared non-performing asset, that 90 days criteria is also in the bank. Perhaps the government wants to have a such type of reporting in case of non-banking companies also or other companies also, whether that loan is being paid timely or not, because that 90-day criteria becomes a triggering point whether the loan will be performing or not performing. But there is no such criteria of performing, non-performing here. But here the auditor has to just report whether it has overdue for more than 90 days. If some installments are overdue for more than 90 days, then auditor has to report those installments. Suppose they are paid after 90 days, but still if then you have to tell that they are not regular in payment. They are not regular in payment. So these points has to be answered, and certainly you have to follow the audit procedure. The Institute of Chartered Accountants has issued a guidance note on the CARO, and they have for every point they have given what is the audit procedure they have to follow. So as far as when you are doing the auditing, I think that procedure, the points which they have written in the audit procedures, if you make out the checklist of those points, I think that will be the practical solutions for carrying out the audit and for compliance of the CARO report, CARO of 2016, and that will be the way how you have to document your file in the working paper file. So there will be a checklist. Checklist will be based on the guidance note which has been issued by the ICAI, and they have sent that audit procedure to be followed by the auditors. And in those points, if you take in your checklist, check those points in the particular companies, and then say yes, no, and whatever your comments are there, and that will be the audit documentation, which will be considered a proper documentation as far as the SA 230 is concerned. So that is the way how the audit for the CARO has to be conducted by you when you are going to certify those points in the CARO. Because whatever you say, you should have audit evidences for it. You should have a proper working papers for it. It is not that at the end of the audit, you just go and tick the yes, you just put this those 16 points in your report and you say yes, okay, they are fine. It is not so. You request audit working papers for why you say yes, why you say no. Compliance of section 185 and 186, these are the points which are giving putting an onerous responsibility on the auditors. You say in respect of loans, investment, guarantee, security, whether provision of section 185 and 186 have been complied with, if not, provide the detail thereof. You see, you know that what are those 185 and 186 in the Companies Act, and what are the requirements of the Companies Act for this 185 and 186, and those points you have to put and then test in your situations and write a yes or no, whether they have followed a proper procedures as prescribed under the Companies Act for it, and then if you found it, then you say if not, they provide the details thereof if there is a non-compliances for this 185 and 186. Now next point which you have to report as an auditor is deposits from public. Dear student, if you see that the point of reporting in the CARO, whatever we are saying, you are also doing, even if there is no CARO at all, still we are auditing those points, but we are not reporting on those points specifically. Here they want a specific reporting, and the point relate basically where the public interest is involved. Public interest. Now we take a deposits from public. There may be a company which has taken a deposit from the public. Now the public interest is involved. Now whether the public is being paid, their interest is being paid regularly, their loan is and deposit is paying whatever when there is a maturity of the deposit is being repaid or not. These certainly, because the public interest is involved, and then the government wants that the auditor should check those points, whether those points, those rules and regulations as prescribed under the Companies Act for the deposits, public deposits, whether they are being complied with or not. If it is not complied with, certainly you have to report it as per the Companies Act. What are the provisions? What are the non-compliances that has to be listed here? And when you are listing it, certainly you require a certain audit working papers for it as an audit evidences. Because you cannot report anything what you just observed and then you write on that one. Tomorrow, after 2, 3 years or 4 years, there may be a case that the auditors, there is some investigation in the company, they feel that they have not repaid to the deposit holders, there is a delay or there is a dispute in that case, and then because auditor's liability is also there, if they have not reported it, certainly then when you will be caught, if there is a disciplinary action filed against that particular auditor, then it has to show its working paper to them. Yes, I exercised my due diligence, I did see, and still if there is something wrong, may happen, may not, but I saw all this paper. What are the due diligence requirement from the auditors? What is the audit procedure prescribed under this by the Institute of Chartered Accountant for checking the public deposits? I did it. I followed it. This is my checklist. I checked this one, and after that, still, if the company makes something fraud and they don't disclose a certain facts to me, then what the auditors may not be held responsible for it. So you have to follow the procedure as prescribed under the auditing standard. In this case, the guidance not gives a procedure, and that procedure has to be followed. Next is about cost accounting records. As you know that in the Companies Act there is one separate chapter for cost accounting records, and there are certain companies which you have to maintain. They have to maintain the cost accounting records. There are very few companies in that case. You have to see that which are the companies. If that company has to maintain the costing records, whether they are proper or not, that they have to see. Certainly you may be taking because you may not be expert in that case. So what are the costing records? Then you may take a representation from the management, and according to that you may also check that they have maintained or not maintained. If they are not applicable, may not be that for the company which you are auditing, these costing records are not applicable, then you write it is not applicable. Statutory dues. Statutory dues, they say that whether the company is regular in depositing undisputed statutory dues. So again, the focus is on whether the company is paying the government dues in time or not, taxes in time or not. Again, a public interest in, because ultimately that taxes will be utilized for the welfare of the public, and therefore the focus is on whether there is a public interest involved or not. And in this case, certainly it is involved. And then the government requires a specific confirmation from the auditors. Whether it's a regular and undisputed means there is no dispute. You have to pay it, but you are not paying it. Why you are not paying? That is not that auditors can't say that because they have no money, then they are not paying. That's not the excuse. You must have seen in case of the Kingfisher, because they were not having a capacity to pay. They deducted a tax and then they are not able to pay it because they are not having any money to pay it. So, but that's not the excuse. Auditor has to report this is the tax which is undisputed. Company is not saying that he is not raising any dispute with the tax authority regarding the payment of these taxes, but still it is keeping just silent and not paying it. So auditor has to report it. It has to make a list. The guidance note on CARO issued by the Institute of Chartered Accountants of India gives the format, in which format the auditor has to report such type of undisputed statutory due which are not which are outstanding or which are not paid in time. Now, whether the dues of income tax, sales tax, service tax or duty, custom duty, value added have been deposited on account of any dispute, then amounts involved in the forum where dispute is pending shall be mentioned. You see that the first point relates that there is an undisputed dues. You deduct a tax from the salary of the employees. You have deducted and you have to pay it as per the law, income tax law. But why you are not paying? Because you have no money to pay it. It is undisputed. You are not disputing that, sir, we are not required to pay it. It is wrong. It is like this. You accept it that it has to be deposited, but you are not able to deposit it. That point will be covered in the first one. But in the second point, it says that you might have got certain dispute. The income tax authorities issued a demand notice to you, and they said you pay 50 crores. But you are not agreeable to that demand. And you feel that no, 50 crores demand is not justifiable as per you, that it should be only 10 crores or something. So you will raise a dispute against that 50 crores demand. And if you have raised a dispute against that 50 crores demand, then it becomes a disputable. It's a disputable demand. Previous one point was undisputed demand. So disputable points you have to report that, then where it is disputed. It doesn't mean you receive a notice, demand notice from the income tax department. It has to be paid within 30 days. You didn't pay it within 30 days. You just keep quiet and you even don't file an appeal and before the next appeal authority. And you just kept quiet, and then you say that no, sir, we are not required to pay. It's a demand is not justifiable, and this one. No, you cannot say like this. That's why the auditor has to report. It says that you have to report that where the dispute arises. Suppose they have not filed an appeal, you cannot say it's undisputed. You can't say disputed. You have to put it as undisputed. Then you cannot say, because they have not raised any dispute before the authority, and that's why that dispute is pending shall be mentioned. And the CARO, a guidance note on the CARO issued by the ICI, that gives the format how that disputed liability has to be reported. But it says that you have to, auditor has to report which is the authority to whom that appeal has been filed, it has been disputed. So if it is issued by the income tax authority, if the assessing officer has issued the demand, certainly the appeal lies with the CIT appeal, whether it is filed with the CIT appeal, or suppose it is now CIT appeal has also been given the decision against you, and then the company has gone in the tribunal, then it may be lying with the tribunal. So that has to be mentioned in case of the CARO report. Next is the repayment of dues. Whether the company has defaulted in repayment of loans and borrowings of financial institution, bank, government, dues, debenture holder, if yes, the period and the amount of default to be reported. In case of default to bank, financial institution, government, lender-wise, details to be provided. This is basically the point of reporting, and it requires a very detailed reporting. Again, dear student, as I told you that what is the basic concept behind the CARO is that government wants a certain confirmations reporting from the auditors regarding those points which are of a public interest. So that's basically the concept. And here that's why this point requires. You say that this company has taken a loan from the banks, but it is not paying in time. Now, from where the banks gives the loan? From the deposit, you make a deposit in the banks. Out of that, bank gives a loan to the borrowers, and they don't pay. They certainly the public money has been somewhere involved, and therefore it requires, because the public interest questions, and that it requires that you have to specifically report on those points. If the company has taken a borrowings from more than 2-3 banks, suppose 5 banks, then you have to report bank wise. What is the overdue amount for in case of a syndicate bank? What is the overdue amount in case of a State Bank of India? What is the overdue amount in case of the Canara Bank? The bank-wise default and the outstanding amount has to be reported. Period of default has to be reported. That is a lender-wise. Next is application of money raised. Whether money raised by way of initial public offer or further public offer, IPO or FPO, including debt instruments. It may not be case of shares, but debentures also. And terms loans were applied for the purpose of which those are raised. If not, the details there, together with the delay or default and subsequent rectifications, if any, as may be applicable, be reported. So, company has raised the money through the IPO. It issued the shares. It has issued the debentures in public through the public offerings. Maybe FPO means further public offering, means you have already issued once a share to the public, now you are raising more money from the markets. Term loans and then whether those are, that amount has been used for the purpose it was raised. You did a FPO, further public offering, you issued equity shares in the markets because you want a more working capital for the expansion of the companies. But the money came and company invested that amount in other companies. It acquired another company. So purpose was not that. While you issued the prospectus, the company issued a prospectus, they want to raise a further money in the market. Why? Because it requires a more working capitals. But when the money came, then it was invested in another company. They acquired another company from this money. Then certainly the auditor's duty becomes here that they have not used the money for the purpose it was raised. It was invested in other companies. It was acquired, another company has acquired for that one. The auditor has to give his reporting like this. If you have raised the loan from the banks, that yes, for the working capital, but you are using it for the purpose of acquiring the fixed assets? No, this cannot be. So the auditors has to examine the use. And certainly whatever the use, you have to see the purpose. If it is a case of a public offerings, then prospectus, the purpose will be mentioned there. If it is a case of a bank, see their sanction letter, which the bank has issued a sanction letter to the borrowers, to your company. Then from that you can have what was the purpose of that loan, and then report accordingly. Fraud. You see, when we talk about the fraud, we have a special, there is one standard on auditing which is talks 240, which talks about the fraud. And the crux of that auditing standard is that it's not the responsibility of the auditors to detect the fraud. It's the management responsibility to make a control, internal control so strong so that detect the fraud. The detection of the fraud does not lie with the auditors, but Auditors can't take the escape of this, that yes, oh, any fraud, it is not my responsibility. If you see the SA 240, it puts the auditors is required, sometimes required to detect the fraud also. Report the fraud. It may not be that you should investigate, but if there are certain indications, what the SA 240 says, that if there are indications, when you are following a general audit procedures, not for detection of the fraud, you need not to design your audit program to detect the fraud. You have to design your audit program as per the generally accepted auditing standards, and where the objective is to report on the true and fairness of the financial statement. Objective of the audit is this. You have a SA 200 which talks about the objective audit. It never talks about the objective audit is to detect a fraud. It's not the objective audit. But you see, auditor cannot also say that no, it is not my responsibility. No. You have a SA 240, what it says that during the course of your auditing, and you are following a general audit procedure, not to detect the fraud, but you came across a certain transactions in your audit procedures, where there are indication of, you are suspecting those transactions, and indication of frauds are there. What that auditing standard says, the auditor has to report it. Auditor has to go to that extent for further checking, not to investigate it, not to make that who committed this fraud, not to say that who are the person responsible for it. It's not the job of the auditors. Its job is that to report there are frauds, what is the quantum of the fraud, and what is the impact on his profit in his financial statement, whether it affects its true and fairness of the financial statement or not. To that extent, the auditors has to do a further audit procedures. So, whenever the question is what this requirement of the CARO is, whether any fraud of the company or any fraud on the company by its officers, the question is here, any fraud by the company. Company itself is doing fraud. So both the frauds are covered. I think the first fraud is that you can know very much, but the second fraud may be difficult to detect. Fraud by the company, you must have seen so many deposit taking company, you must have seen the companies which are formed, and their purpose of they are collecting the money, and the way they are collecting the money itself is a fraud. So in that, company itself is doing the fraud with the public. But there are some that public, the objective of the company is not that way, but during the process, its employees and its officer commit a fraud. They siphon off the money. But where the company itself is doing the fraud, the auditor has to report both the frauds. Fraud by the company or fraud on the company, both one. Certainly, as I told you, that basic responsibility of detection of the fraud and to design an internal control system in such a way that fraud is timely detected is the responsibility of the management. It's not a responsibility of the auditors, but auditors' responsibility is prescribed under the auditing standards. Dear state, the Institute of Chartered Accountants has issued a guidance not on this fraud, on how to report, to what extent the auditors, what is the responsibility of the auditors about this point. So, but again, there is no response, the basic responsibility is not the auditors. It has to follow a general audit procedures, and audit procedure prescribed under the general auditing standards like SA 240. And if according to that 240, auditors comes across to that fraud, then there is a procedure prescribed under the Companies Act that fraud, more than one fraud has to be reported to what? To the central government, and for that reporting also there is a procedure for it, and the auditor has to follow that procedures in that case. Next is about managerial remuneration. This is another new point in this CARO 2016. It says that whether managerial remuneration has been paid or provided in accordance with the requisite approval mandated by provision of section 197, read with schedule 5th. If not, state the amount involved and steps taken by the company for securing the refund of the same. As you know that the section 197 talks about the managerial remuneration, and it applies only to the limited companies, public limited. It does not apply to the private limited companies. Now, there is a procedure of calculating the profits there. It says the maximum managerial remuneration is 11%. If there is a one director, then 5%. If there are more than one director, then you have a 10%. And then if you have a more than three director, one managing director, more than director, then the total overall limit is 11% of profit. And how the profit has to be computed, that is also prescribed under the Companies Act. So the auditor has to design a checklist for it. And the checklist, as I told you, that if you go through the guidance note on this CARO, the guidance note clearly prescribed the steps the audit procedure has to be followed by the auditors. And if you follow that audit procedure, then you report that whether the excess remuneration has been paid, what are the steps taken by the company, and whether if excess has been paid, which has not been approved by the government, then what are the steps taken by the company to get refund from the managerial persons, that excess amount. Next is the point which it has report about the Nidhi company. You see, Nidhi companies are if you go to the Companies Act 2013, that define the Nidhi companies. And I think in the corporate law paper you must be studying that, what are the Nidhi companies. But basically the Nidhi companies are mutual companies that people have come together and they have deposited their money. They are giving the loan to only to the members as against the NBFC, non-banking financial companies, which gives the loan to anybody else. Not to only, it is not restricted only to the members. So those are the Nidhi companies. They are very restricted one. But about that, the government wants that the auditors reporting on that particular point. You will be finding a very few companies like Nidhi company in practice. You will be finding most of them are NBFCs, non-banking financial companies. Whether the Nidhi company has complied with the net owned funds to deposits in the ratio of 1 to 20, because they are allowed 120, means if you have a own fund of 100 rupees, then you can take a deposits of 20 times of means 2000 rupees. So 120 ratio has to be maintained, and there's the auditors who it has to compute and report it if it is not mentioned. It has not maintained that 120 ratio. Meet the liability, and whether the Nidhi company is maintaining 10% unencumbered term deposit as specified in Nidhi rules, because the Companies Act 2013 gives the rules regarding this Nidhi companies, and that is called the Nidhi companies rules. Rules to meet the liability, then auditor has to see those one whether it is complied with, and if not, then report it. Next is the related party transaction. Whether all transactions with the related parties are in compliance to 177, 178, where applicable, and details have been disclosed in the financial statement as required by the applicable accounting standards. Now, that's the applicable accounting standard. First, the sentence is whether all transactions with the related parties in compliance with the 177 and 188 where applicable, and the details have been disclosed. You see, 177, 120, because these two sections talks about the related party transaction. Now the related party definition under the Companies Act different, and the under accounting standard 18 is different. What it says that in the first part of it, whether all transactions with related parties are in compliance to 177, 188 where applicable, here the auditors has to comply with the rules and regulations prescribed under the Companies Act with the related parties as defined under the Companies Act. Now, as regards the disclosure requirement, it says that disclosure have been disclosed. When the question of disclosure comes, disclosure has to be done only for those parties which are mentioned a related party under accounting standard 18. So, the disclosure is for the restricted one, because as you know that under the Companies Act, the related parties are huge. In the under the AS18, the related parties relatives are only 6 and 7, whereas if you see in the Companies Act, there may be 10 or 20. So the question is that as far as the compliance of 177, 188 is concerned, it is for all transactions, for all related parties as prescribed by the Companies Act. The definition of related party in that case is a Companies Act definition. and auditor has to report whether they are in compliance with the Companies Act. But as far as the disclosure part, the second leg of this this point is concerned, it requires a disclosure is required only as per Accounting Standard 18. And Accounting Standard 18 requires a disclosure for, it has given a definition of related parties which are entirely different than, it may be, it's a restricted one. It means that it is out of them, some of the related parties are required to be reported under AS 18. So what the auditor has to see that whether the reporting requirement, disclosure requirement has been met as per AS 18, and whether transactions with the related parties are in accordance with the law, that has to be seen as per with the related parties. The related parties in that case has to be, definition will be from the Companies Act, and that is more one. That's more wider than the AS 18 definition. So the auditor has to see that whether those transactions, 177, 188, which talks about the related parties, are as per the provisions of the Companies Act, because it has a certain procedure. The law does not prohibit to enter a transaction with related parties. It says yes, okay, you can do, because business has to be done, and it is not restricted. But it says that you have to follow this procedure as prescribed under the Company. That if they don't follow, then auditor has to report that the transaction with these parties, the board resolution is not there. Some transaction has to be approved in the AGM of the company, that is not done, or what is that? This has to be reported. Next point is about the preferential allotment. As you know, the preferential allotment means that, because you see, once you do if you make a allotment of shares, further allotment of share to a specific shareholders or a specific person, then it's a preferential. Otherwise, you have to make a right issue. If there are existing shareholders are suppose 50, and if you want to issue a more share, then you invite all the 50, and then as per your ratio, because if you have a existing 1 lakh share and you want to issue more 1 lakh, then means the person who is holding 1 share, he will be given, he has a right to subscribe 1 more share. But you don't want to offer to all suppose your total shareholders are 50, so you don't want to offer this 1 lakh share to 50, you want to offer only to the 2 shareholder or 3 shareholder, then it's a preferential allotment. It's a preferential allotment. So in that case, if it is a preferential allotment, the Companies Act, that section prescribes, section 42 prescribes the law for it, the procedure for it, what is the legal requirement you have to fulfill for the preferential allotment, and if those preferential allotment requirement has not been fulfilled, then the auditor is duty bound to report under this point that these are the requirements. A specific requirement may be that they have not kept the money in the bank account, they have not made an allotment within 30 days. These some of the requirement, which requirement has not been complied with, and that has to be mentioned by the auditors under this point. Non-cash transaction with the specified person. You see, the Companies Act, there is a one section 192, because if there are cash transactions, that will be mentioned in the maybe the related party transactions. Okay, there is a certain procedure for it, but there may be certain non-cash transaction, and the cash transactions have got a certain measurement, and therefore perhaps the law thinks that fine, there will be a separate category for the cash transaction, but if they have entered in the non-cash transactions, then they have to be looked more carefully, and that's why perhaps to see the public interest on it, because they are these transactions are looked more suspicious than the other transaction with the related parties. So the specified persons may be the managing director of that company, or the son of the managing director, or relative of the managing director, or the certain the big shareholders having an influential shareholder having a shares of 10% or more. You have made a non-cash transaction. Non-cash transaction may be that he has given you some land and they have taken some building in some other areas. So there is a non-cash transaction involved. There is no cash inflow and outflow is not there from the companies. Non-cash transaction. The question here is why these transactions being looked separately, and why the government wants a separate reporting on it, because these becomes more suspicious regarding the valuations, whether these transactions are correctly done with the fair value or not. There the comment is required in case of the auditors, whether non-cash transaction with the directors or person connected with him. If so, whether the provision of section 192 have been complied with, because section 192 gives the certain points, the procedure to be followed by the company. They can do the non-cash transaction. There is not a prohibited area, but this particular the procedure has to be followed. Whether the company has followed it or not followed it, that becomes a question number. Or whether it has followed, then it will write yes. Not followed, then they cannot say not followed. You have to write what is not followed, what is written under the act, and which has not been followed by the company. That the answer has to be specific in that case. Do you understand? This is the point of registration under the RBI Act. It has been added new here this time. Previously, there was no such point. In 2016 CARO report, this is the one of the point. And it was happening because sometimes when we were doing the auditing, there is some definition of the non-banking financial companies given under the RBI direction. They say that there are some, what is the meaning of non-banking financial companies? It is a company which is doing the non-banking business. Banking means they are accepting a deposit, giving the loan. It's a banking. There may be a non-banking company. They are not accepting a deposit but giving a loan. They are a non-banking financial company. If they are accepting a deposits, giving the loan out of that one, they are also non-banking financial companies. So question is that there is some category of non-banking financial companies, and if NBFC, you come under the NBFC, then there is the RBI regulation applies to you. There may be companies which are considered to be NBFC as per the RBI regulations, but they are not complying with the RBI regulation because either they are not aware of it, or if they are aware, they don't want to comply with it. Company may be carrying on the manufacturing process. Maybe they are manufacturing the electronic items. Company is having a very surplus fund in that case. It has made an investment of surplus fund. Its total assets are suppose 200 crores and it has made an investment of its surplus fund to earn the income maybe 120 crores because it is sitting with the cash reserves, and it thought that it is better to invest it somewhere, 120 crores. And on that it is getting an income maybe 15 crores. Now the company total turnover is 25 crores. Out of this 15 crores is the interest or dividend income. Company assets are 200 crores. Out of this 120 crores or 115 crores are the financial asset. What the RBI regulation says that if out of the total assets, more than 50% are the financial asset, which is in this company, yes, it is 200 crores total assets. Investment itself is 120 or 25 crores, more than 50%. The total turnover income from operations is 25 crores. Out of this 15 crores is interest and dividend income, financial income. Then RBI regulations say that they have to get themselves registered with as a NBFC with the RBI. And they may be no, incidentally it happened. It's a auditor's duty. It has the special duty cast under CARO on the auditor that please report such type of company so that the government can bring such type of company under the RBI regulations. So that's one of the very big responsibility has been put. Earlier it was not so. That is the points. These are the points which has to be reported. They are all 16 points here. But the order says, which I have told you in the very beginning also, all the 16 points has to be reported. You can't miss anything. If it is yes, write yes. If it is no, please write no. But as I told you that the CARO says reasons to be stated for unfavorable or qualified answers. If you are saying no, physical verification has not been conducted, you have to write a reasons for it. Why they have not conducted? Because the company has no policy for conducting it. So, what is the reasons for your qualified opinion, unfavorable comments? That reason has to be stated. So, it is not that the company just auditor writes yes or no and thing is over. No. Wherever, you see, if you go even the standard on auditing 700, where the auditor's report is 705, when you make a modified report, 706 is there, you have to write a reasons for it. Why you are making your qualification? The basis of qualification has to be written. And that is the form of, as per SA 705. So, this is the form, the SA 705, the same thing is here. If you write that company is not paying the dues regularly, why? You say that they have not paid. You will write a reason. The statutory due becomes due on 7th April 2015, but they are not paying it. That's the reason you have to specifically write what is the delay and all these ones. So you cannot just escape that they have not paid. You don't give an instances. So you have to write for it, and that's the basic point on it. If the auditor does not do it, they just no, they have not complied with this requirement. If they say no, they have made the further public offering, but they have not complied with the sections of the Companies Act, it will not be sufficient. What they have not complied, write specifically what is the compliance required from the company and what they have not complied with. So this has to be written in the report itself. If the auditor is unable to express any opinion or answer in any particular question, his report shall indicate such fact together with the reasons. Sometimes you may say, sir, I don't know. Auditors can't know the reason, can't quantify it, can't write a basis of it. They ask it, you ask the management, have you made a further public offering? They say, yes, we made it. See the prospectus, you have seen everything. But they don't provide you any information about the utilizations of it. Any information about the utilization, and they provide you information from which you cannot make anything, where they have been utilized. Then certainly you have to write. You have to write. We do not say, we can't say that we can't comment upon the utilization of that money which was received by the company by further public offering. Why? You have to write a reason, because the company has not provided any information about the utilization of it. So you have to write it, because you are not able to. Certainly, if it is so, certainly when you are writing in your auditor's report, because when you are writing a CARO report, at the end you have to think over it, whether such type of qualifications, such type of unfavorable comment under the CARO also affects your main report which are given under SA 700. Whether the qualifications are required there, whether you have to issue the modified report there, because it may affect the true and fairness of it. So that has to be also assessed at the end of when you report all the point in the CARO, after that please assess whether it has to be reported in the main report or not, because it has got a bearing on the true and fairness of the financial statements. So that has to be assessed. And after that, when you have assessed it, then you please decide on that. There may be a point, there may be a certain unfavorable points which you have reported under the CARO, they have no impact on the true and fairness of the financial statements, then fine. You need not to qualify your report there, but you have to make a reassessment of all the points, whether they have an impact on the true and fairness of the financial statement, whether they have to put there. There may be a points which has got an impact on internal control over financial reporting. So you have made unfavorable remarks in the CARO report, maybe about the fixed assets, maybe about the inventories, and you feel that no, it has an impact not on the main report, but it has an impact on the internal control over financial reporting. You have to report that point there. So please, whenever after assessing and reporting on the CARO, After that, the auditor has to do whether these impact of this unfavorable reporting under the CARO on the 16 points, whether it has an impact on true and fairness of the financial statement. If yes, please report there also. Modify your report. If not, then again see whether it has got an impact on internal control over financial reporting report which you are making in the Annexer B of the main report. If yes, please report that one also. And if not, please write in your working paper, they have no bearing on neither on the report, auditor's report, main report, nor on the internal control over financial reporting. And therefore, the favorable report does not require any modification in these two reports, which are annexes to the main report. So, dear students, that's all about your CARO 2016. And this becomes somewhat important from the point of view of the November 2016 exam, because it is a new one. It became effective only from 31st March 2016 reports, and therefore you have to give a special attention for it. And because whenever there is a new amendment, nothing else, the new amendment, then certainly it attracts the attention of the examiner, and he may incorporate it in the paper, and maybe in very small point, particularly those points which are new in the reports, like of your the RBI 45I, you have regarding something about the FPOs. These are some of the points which has been additionally put there, that on that case you have to give regarding about the your fixed assets, where they have to examine the title deeds of your immovable properties, like this, which has been added further. In that case, there are these points which has been added new. You please give more attention to them. Otherwise, you see, this the part of your company's audit, and you have to take it other way. And you please, sometime you have in your study module the extract of, and must be in the study module you have the guidance note of it. And in the guidance note, whenever you are reading the guidance note on CARO, please give attention to wherever in the CARO guidance note, wherever the audit procedure is prescribed, suggested by the ICAI, you have to give your due attention those points. What I feel is that if you only remember those points or only understand those points, that will be more than sufficient for giving your exam on the CARO, if you understand those audit procedure prescribed under the CARO. Thank you very much.